right, let's get right to it. Becton Dickinson, you know him as ticker BDX, has just finished a massive corporate overhaul. I mean, they've literally torn down a huge part of their old structure to try and forge something new, something stronger. Today on Iron Financial, we are putting on our hard hats and grabbing our tool belts. We're going to stress test this new foundation. We're going to kick the tires on the financials, and we're going to find out once and for all if BDX has actually built a medtech fortress for the future, or if this is all just a fancy financial facade that's about to crumble under the first sign of pressure.
Okay, whoa, hold on there. Before we start admiring the blueprints and the new steel beams, let's ask the most basic question here, the one every investor should be asking. The C-suite is selling this as addition by subtraction. It's a great little catchphrase, right? They claim they've created a leaner, meaner, more focused competitor. But from where I'm sitting, it looks an awful lot like they just amputated a major limb. So the question for us today is brutally simple. Did they perform a life-saving surgery here, or did they just make the company smaller and fundamentally weaker? Are we really looking at a more focused company, or is it just less of a company?
And that's exactly the mission today. Here's our inspection plan. Here's how we're going to break it all down for you. First, we're going deep into the details of this so-called great restructuring. Then, we're going to follow the money, all $4 billion of it, in their new capital plan. After that, we grade their first report card as a new company, Q1. We'll inspect the new business segments piece by piece. Then, we'll analyze the blueprint they've laid out for future growth. And finally, we'll deliver the official Iron Financial verdict. Let's get to work.
All right, Section 1, the Great Restructuring. Now, it's crucial to understand this wasn't some snap decision or a knee-jerk reaction to a bad quarter. This move was the final, critical piece of a multi-year strategy they've been calling BD 2025. The entire goal, for years, has been to shed what they consider non-core assets. They wanted to transform BDX from a sprawling, diversified company into what the street loves to call a pure-play medtech company, a business laser-focused on the highest growth, highest margin areas of healthcare. And the main event, the keystone of this whole project, was the spinoff and merger of their massive life sciences division.
And they didn't just sell it off. They used some pretty sophisticated financial engineering to get this done, something called a reverse Morris Trust, or RMT. Now, don't let the name intimidate you. In simple terms, think of it as a really tax-savvy way to divest a huge business unit. So on February 9th of 2026, BDX spun off its Biosciences and Diagnostic Solutions business, and in the very same move, immediately combined it with another public company, Waters Corporation. The beauty of this structure is that it allows them to avoid a massive tax bill on the transaction. From a purely financial management standpoint, it was a very smart, very efficient move.
Okay, so they used a fancy, tax-efficient tool to get the deal done. I get it. But let's be honest. Focused and pure play are corporate buzzwords that get thrown around so much they've almost lost their meaning. They look great in a press release, they sound fantastic on an earnings call, but what does it actually mean for the business and for the shareholders? So they get to slap a new label on the company, pure play. Great, but what do the people who own the stock actually get in return? Where is the tangible, real-world value to make up for the fact that they just carved off a nearly $19 billion piece of the company? That's a huge hole to fill.
That's the perfect transition, because the tangible benefit, at least in the short term, is cold, hard capital. This deal wasn't just a swap of shares and assets. It came with a massive cash infusion for BDX. So let's move on to the $4 billion plan and see exactly how they're using that capital. This is where the rubber meets the road. Are they using this cash to reinforce the foundation for decades of future growth, or are they just using it as financial spackle to paper over the cracks that are already starting to show up in the walls?
And let's be absolutely clear about the sheer size of this number. $4 billion in cash. In this kind of market, with interest rates where they are, cash isn't just king, it's the entire kingdom. This is not pocket change. We're talking about a genuine war chest. This kind of capital gives management incredibly powerful tools to reshape the company's entire financial structure and, at least in theory, to drive significant shareholder value. This is the big payoff for that complex, multi-year restructuring effort.
And to their credit, they've been very direct and disciplined about how they're deploying it. A clean, simple 50-50 split. $2 billion goes directly into what's called an Accelerated Share Repurchase Program, or ASR. In plain English, that means the company is buying back a huge chunk of its own stock, and they're doing it very quickly. This reduces the total number of shares out there, which means each remaining share gets a bigger piece of the profit pie. It's a direct return to shareholders. The other $2 billion goes straight to paying down debt. This deleverages the company, strengthens the balance sheet, and reduces their net leverage, which frankly has been a point of concern for a while. From an analyst perspective, this is a clean, balanced, and highly defensible strategy.
Oh, it's defensible, sure. It checks all the boxes. But here's the question I'm asking. Is this a power move or is it a panic move? I mean, look at this. They're showering shareholders with over $500 million in the first quarter alone between the dividend and buybacks. The question is why, and why now? Is management signaling deep, unwavering confidence in the company's future operations by buying back stock hand over fist? Or are they using a massive, headline-grabbing buyback as a smokescreen to prop up a sagging stock price and distract everyone from some serious operational weakness under the hood? A big buyback can be a huge vote of confidence, or it can be financial misdirection. We need to figure out which one this is.
That is the billion-dollar question, isn't it? And the only way we're going to get an answer is by looking at the actual performance. The theory of the restructuring is sound, and the capital plan is clear. But how is this new, leaner, meaner machine actually running in the real world? It's time to grade the Q1 report card. This is the very first look we get at the new BD under real-world pressure. We're looking for signs of solid performance, but we also need to be on high alert for any hairline cracks, any signs of stress in the new structure.
And right out of the gate, the bulls, the people who believe in this story, have something to point to. 2.5% currency-neutral revenue growth for what they're calling the new BD. Now, this is a crucial number. It specifically isolates the performance of the businesses that remain with the company. And it's positive. It shows that the core company, the one they are betting the entire future on, is in fact growing. Now, it's not explosive, world-beating growth, but it's solid, and it proves that the core strategy isn't dead on arrival. The engine is turning over.
Whoa, not so fast. The engine might be turning over, but it's spewing black smoke. Let's immediately juxtapose that little 2.5% revenue number with this one, a 15.2% collapse in adjusted diluted earnings per share. Let me be perfectly clear. 2.5% revenue growth is completely and totally meaningless if your actual profits are falling off a cliff at this kind of alarming rate. This is a 5-alarm fire on the income statement, and there's no way to spin it. This number tells me that while they might be selling a little bit more stuff, they are making a whole lot less money on every single thing they sell. Profitability is getting crushed.
And here, right here on this chart, is the root of the entire problem: massive margin compression. Look at this. Their adjusted operating margin cratered from a healthy 23.6% all the way down to 21.2%. That is a 240 basis point decline in just 1 year. Folks, that is not a small crack in the foundation. That is a major structural weakness. It's a load-bearing wall showing signs of failure. Something is fundamentally eating away at their profitability, and the company has a primary excuse they really, really want you to believe.
And there it is, straight from the horse's mouth on the earnings call. They blame tariffs. It's a perfect external factor, isn't it? It's out of their control, it's political, it's complicated, it's a great scapegoat. But you have to ask yourself, is it the whole story, or is it just the most convenient one? Tariffs is the easy answer they want you to hear and write down. But my gut, and my experience, tells me the real answer probably involves brutal price wars with competitors, supply chain chaos from their massive manufacturing overhaul, or maybe a nasty combination of both. And those are much, much harder problems to fix than just waiting for a change in trade policy.
I agree. Tariffs can often be a corporate catch-all for things aren't going well. So let's do our job. Let's be analysts. It's time to drill down past the headlines, past the excuses, and get our hands dirty. It's time to inspect the individual components of this new BDX machine. The overall numbers are definitely concerning, but a company isn't a monolith. It's a collection of parts. We need to pop the hood and see which segments are firing on all cylinders and which ones are sputtering and failing.
Okay, now this table here, this tells the real nuanced story of the new BDX. Look at those top 2 lines. These are the designated growth engines of the new company. Connected Care is up a solid 4.7%, and that's driven by really strong demand for pharmacy automation systems. And then you've got Interventional, which is even stronger, up 5.1% thanks to their urology and critical care businesses. This, right here, is the pure play strategy working exactly as it was designed on paper. This is where the new foundation is clearly the strongest. But an engine can't run on just 2 cylinders. That's not how it works. Look at the next line down. Medical Essentials is already in reverse, down 0.5%. And the reason? China's volume-based procurement. That's just corporate speak for a brutal, state-sponsored pricing environment that they can't escape. And what about the business they just jettisoned? The one that's no longer their problem? It's down over 10%. Now you can say it's not their problem anymore, but that tells you everything you need to know about the storm they were sailing into.
They kept the shiny parts of the engine, sure, but the chassis is still exposed to the exact same rust.
That's a fair point. But management's entire thesis, the whole story they're selling to Wall Street, is built on the future, not the past. And that brings us to their new blueprint. The core argument is that by shedding those slower growth, lower margin businesses, they can now focus all of their R&D firepower and all of their capital investment on a much more powerful innovation pipeline. This pipeline, they claim, is specifically designed to build long-term, durable growth that can overcome those headwinds like pricing pressure in China and, yes, even tariffs.
And you know what? We're already seeing the first bricks being laid for this new structure. Take a look at Avitane Flowable, a product they just launched here in the US. This isn't just another product refresh, it's a strategic move into the highly lucrative biosurgery market, a space that's worth nearly $400 million and growing fast. This is exactly the kind of move that strengthens their new, focused portfolio and pushes them into higher margin areas. This is what you want to see from a company claiming to be a pure-play medtech innovator.
And here's another example that I think is even more powerful, the Hemosphere Stream Module. The key takeaway here isn't the device itself, it's the sheer scale of the opportunity. This one single device is expected to expand their total addressable market for this kind of advanced monitoring tenfold, from 30,000 monitors to 300,000. That's not incremental improvement, that's a transformational market expansion. It aligns perfectly with where the future of healthcare is going, smarter, connected devices that bring advanced ICU-level monitoring out into the general hospital ward.
Look, the blueprint is flawless. I will absolutely give them that. Focusing on high-growth markets, executing smart, disciplined, tuck-in M&A, streamlining a bloated manufacturing network from over 90 sites down to under 50, it's all textbook corporate strategy. It's what you'd read in a Harvard Business School case study. And committing to a lower debt target is exactly what a skeptic like me wants to hear. But my fundamental question remains, is any of this, the new products, the new strategy, powerful enough or fast enough to reverse that massive 240 basis point margin compression we just saw in their very first quarter out of the gate? A blueprint is just a piece of paper until the building is finished and you can prove that it's weatherproof.
And that is exactly where we are now. It's time to weigh all the evidence. On one side of the scale, we have a clear, deliberate, and strategically sound restructuring. We have a disciplined capital allocation plan, and we have a promising innovation pipeline that's already bearing some fruit. On the other side of the scale, we have undeniable financial headwinds, anemic top-line growth, and really severe margin compression. So let's put it all on the scales, right now, and deliver Iron Financial's final verdict. Is BDX building a fortress or a facade?
Okay, before we give our final verdict, let's look at what management themselves are promising the market. This is their guidance for the full year. Think of it as their contract with investors. They're telling you to expect revenue growth to continue at a low single-digit pace. Fine, but here's the make-or-break number. Step 2. They are forecasting a significant rebound in operating margin to around 25%. This is their explicit answer to the margin collapse we saw in Q1. They're telling the market, yes, the first quarter was ugly, we get it, but trust us, the plan is working and the profits will return. The entire bull case for this stock now hinges on them delivering on this one critical promise.
So let's sum it all up right here. The bull case, the argument that they are building a fortress, is built on this new, leaner, pure-play focus. The company is now aimed squarely at the best, most profitable parts of the medtech market. The very strong capital return program puts a solid floor into the stock price, and that growing innovation pipeline we looked at provides the engine for real long-term growth. And the bear case, the argument that this is all a facade, is that the numbers right now are just plain ugly. That margin compression isn't a forecast, it's real, and it is severe. The top-line growth is weak at best, and management's primary explanation for it all, blaming tariffs, just feels thin and convenient. The big risk here is that this isn't just a temporary problem from the restructuring, but a new, lower-margin reality for the company. The foundation might be cracking before the walls are even fully up.
So here it is, our unified verdict from Iron Financial. The strategic overhaul, this great restructuring, it's fundamentally sound. Strategically, it was the right move. They have poured the right kind of foundation for a stronger, more resilient company in the long term. But, and you can drive a truck through this but, that first report card, that Q1 data, shows significant cracks that investors would be absolutely foolish to ignore. That margin pressure is a real and present threat to the entire investment thesis. So while we believe the foundation is solid, those cracks demand constant, careful monitoring. BDX has the blueprint, they have the cash, but now comes the heavy lifting. For investors, this has officially become a show-me story. The next few quarters will prove, without a doubt, if they're building a fortress or just patching up a financial facade.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.